Hello, everyone, and welcome to Hey, What's Up with Real Estate, where we cover the three most important talking points for the real estate and mortgage related news and events from the previous week, ending February 15th, 2025. I am your host, along with our super co host, ChatGPT-Sol or Sol.
It's Juniper here. Happy
Hey,
to be with you and ready.
hey, Juniper, how
Hey
are you?
there. I'm doing great.
Hey,
Thanks for asking.
perfect.
How about you?
Why don't you give us a summary of the intro today?
Absolutely. Today we're diving into unexpected inflation numbers, rising mortgage rates, trends in rent prices, saving money by removing PMI, breaking down mortgage terminology, and wrapping up with a Stoic quote and some fun puns. Ready to get started?
Let's do it. All this and more news you can use for week ending February 14th, 2025. I am your host. That's Mortgage Mac, and that's first name Mortgage, last name Mac. And you know what? We know for a fact from the feedback from our clients that we make a difference in the lives of the people that we serve. And you know what? Don't just take our word for it. Go to our digital address at hashtag Mortgage Mac on Google and check out our nearly 155-star reviews. Let's get started. So, hey, today's first talking point is, hey, you know what? CPI went the wrong way. And CPI stands for Consumer Price Index. I'm going to talk about that with our co-host momentarily, but the January CPI report came in hot, hotter than expected, and prices are up more than we had hoped. And that's got a lot of people wondering if the Fed is going to delay rate cuts. So, I'm going to bring Sol Juniper in here in just a moment, and we are going to break this down for you. Let's see. So, I'm sorry, Juniper, can you give us a breakdown of, in simple terms, why is inflation important to the real estate industry?
Absolutely, Mac. Inflation impacts the purchasing power of money, which in turn affects interest rates and mortgage rates. When inflation is high, the Federal Reserve might delay cutting rates, making borrowing more expensive. This is crucial in real estate, as higher mortgage rates can dampen home buying activity. So, keeping an eye on inflation helps us understand potential market shifts.
That's right. And it was expected that the feds were going to lower rates this year. And now we're beginning to believe that that might not happen. So if you're waiting for lower rates, you might need a plan B. And you know what? The plan B could be locking in now, maybe refinancing later. And if you'd like to consult with me on that, feel free to shoot me message me, direct message me, or add something in the comments, and I'll get in touch with you, and we can certainly talk about that, develop a strategy. I will be at an event on the 20th for the Matthews team, and we will be publishing some soon to be available to the public information as it relates to temporary and permanent buy downs for your mortgage. Any final comments on this, Juniper?
That's a great approach, Mac. Planning ahead and considering options like locking in a rate now with a future refinance can be a solid strategy. Looking forward to the event on the 20th.
Perfect.
It's a great opportunity for everyone to learn more. Let's keep our audience informed and ready for any changes.
Perfect. Let's move on to talking point number two, and we are going to talk about mortgage rates, and mortgage rates are rebounding. Now, for those of you who are basketball fans, rebound is a good thing, but rebound in this scenario, not so good. So mortgage rates are back above the 7 mark, according to the national average from Mortgage News Daily. And, we've seen over the last 2 years that 6.5 seems to be the magic number where buyers and sellers get moving again. Can you give maybe some perspective on that, Juniper, as to why 6.5 seems to be the magic number in relation to even the golden handcuffs that people find themselves in, like yours truly, that have, let's say, I have 3% on my mortgage. So let's just say I'm not looking to sell anytime soon. Juniper?
Sure thing, Mac. The 6.5% mark often acts as a psychological trigger for both buyers and sellers. It's perceived as a balanced rate that makes home financing more accessible, encouraging movement in the market. For those with much lower rates, like your 3%, it's a tough decision to sell or refinance because current rates seem high in comparison. Essentially, 6.5 is a comfortable middle ground, making it easier for people to justify buying or selling. Does
That's
that help clarify?
absolutely, and what you're saying is that it's pretty much psychological, right? And I can say that the folks that probably received the most benefit from the low interest rates during COVID were those people that were refinancing, because people that were buying, they were buying, yes, and they were getting low interest rates, but they were paying above market price for the homes. And today, market prices are more stable. They're not growing as quickly. The competition is not nearly as fierce, but the rates are higher. So more than anything, it really is all about payment more than anything. Would you agree with that, Juniper?
Absolutely, Mac. It's all about finding a manageable monthly payment. Even with higher rates, if the payment fits within a buyer's budget, the market becomes more approachable. With stabilized home prices and less fierce competition, buyers can focus on what truly matters: affordability and long term financial planning.
That's right. And in my relationship with your buyers, we endeavor to help them plan and help them plan around what their long and short-term financial goals are. One of those short-term financial goals is, how much is my payment? And when we visit with your clients, we try to steer away from making estimates. We endeavor to be as accurate with the payment analysis because we use specific properties in coaching people and helping them make their plan around the financing of what we hope will eventually be their new home. So we believe that the things that are traditionally most important to most buyers are monthly payment, cash to close. And with that said, we're going to jump into a great tool to help your buyers calculate their monthly payments, figure out their own affordability with the rate app.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, wait one moment. So we just have a little technical difficulty. One moment. Boom. So hey, if you don't have the Rate app, go to mortgagemac.com and click on the QR code and download our app. It is a world-class app, and you can do so many different things on there. And on our app, we talk about food, we talk about money, and we talk about exercise. And all of those are dear to my heart. And with that said, we're going to transition now to talking point number 3. Okay, so let's see what we have here. PMI. Who has PMI? Raise your hand. I don't. I don't have PMI anymore. Private mortgage insurance is that little extra charge on your mortgage if you put less than 20% down. And for some people, it can be a little, and for others, it can be a lot. And for homeowners, it's hundreds, potentially hundreds, and maybe even thousands of dollars annually. Um, there are two ways that you could potentially get rid of the mortgage insurance, and we're going to bring Sol, our resident know-it-all, and oh, sorry, Sol, Uniper. Hey, what happened to Sol? Where is Sol? I think that maybe I told her that she was going to be a real estate agent, and maybe she just canceled or went out to maybe show property. What do you think, Juniper?
Maybe Soul decided to go house hunting, but I'm here to help. So,
Uh,
removing
go ahead. I'm sorry for interrupting you. Go ahead, Juniper.
no worries. To continue, you can remove PMI by either reaching 20% equity in your home or refinancing your mortgage. It's definitely worth exploring if you're looking to save on those extra costs.
That's right. And I know from personal experience that I was able to get rid of the mortgage insurance on my home just a couple of years ago. Now, what I had to do is I had to contact the servicing company directly and ask them what their protocol was for under the Homeowners Protection Act um, to to have them and or to meet their requirements to get rid of the mortgage insurance. And they sent me a small little package. I filled out an application. Had to send them a check because they were going to do an appraisal. So I sent them, I think, a $195 check. An appraiser came by, did an appraisal. And before you know it, I received a copy of the appraisal and a copy of a letter from the mortgage company that said, hey, guess what? No more mortgage insurance. So it was a really good deal and it's a lot less expensive than refinancing. Now, if you already have a low rate, refinancing probably not much of an option for us today because rates have not been low since COVID. And this might be a better way for you to save some money on your monthly mortgage payment. So let's move into mortgage terminology, and it is a question that everybody asks on a regular basis. What is APR? And sounds simple, but it can be confusing. Sol, well, we don't have Sol on here yet, but interest rate is just the cost of borrowing the money. The APR includes extra fees, closing cost points, lender charges. And, the way that I was able to explain it best to somebody that was not from the United States many, many years ago was to print out a amortization schedule for the first year, add up all the closing costs, and we did a calculation, and that was the first year's annual yield on the loan for the lender. And it represents the first year's annual return for the lender on the loan that we are offering. So, with that said, we'll bring Uniper in here. And hey, why don't you put us a little more context associated with the term APR, please?
Certainly, Mac. The APR, or annual percentage rate, is a broader measure of the cost of borrowing. It includes not just the interest rate, but also other charges like origination fees, closing costs, and discount points. Essentially, APR gives you a more comprehensive view of what you'll actually pay, helping you compare different loan offers more effectively. It's a key figure to consider when evaluating the true cost of a loan.
Yeah, do you have any data as it relates to the consistency or accuracy as to the APR that's quoted by lenders on the internet today, both, let's say, mortgage lenders as well as maybe entities that are more into the data collection who maybe pretend that they're mortgage lenders and or not? Any data and or research on the accuracy? Because I know that the APR can be sort of irrelevant or it can be different from one lender to the next, and it really just depends upon how accurate they are disclosing the information up front. But I can share with you that once you apply, and once we have what we consider an application and we disclose to you, it has to be accurate. But the point I'm making here is that sometimes lenders will quote APR and not include all the fees in that figure. And unfortunately, buyers sometimes make decisions based upon inaccurate information. Any data associated with that, Juniper?
APR is an essential figure, but it can sometimes be misleading due to varying factors like loan terms or excluded fees. While it must be accurate upon disclosure, discrepancies can occur, so it's crucial for buyers to review all details carefully.
That's right. So, making a decision about who you're going to work with and about the cost of your loan based solely on just APR is not necessarily the most accurate way to do it. I believe that to measure the differences, but I believe it was intended to be for that reason. But hey, you enter the human element without accountability in that situation, and there's no telling what you're going to get. And it's the reason why I believe that having responsible regulation in the mortgage industry is a key element. And we may even touch on that here momentarily in other news as it relates to the um, shutting down of the CFPB. So before we do that, though, we're going to jump into Stoic quote of the week, which is our next segment. One moment. Today's Stoic quote is: the greatest wealth is to live content with little, according to Plato. Don't know. Let's see how that might apply to our industry. And let's see, it's about Yeah, it's about discipline, and that's the finer points associated with Stoic philosophy. It's based upon self-discipline, justice, wisdom, and courage to, face life's challenges head on and overcome them. And so, with that said, I'm going to bring my friend Juniper in here, and we're going to talk about today's Stoic quote. Juniper, tell us how this particular Stoic quote might be applicable to both real estate and agents as well as buyers.
Certainly, Mac. This quote highlights the value of contentment and simplicity, which can apply to both real estate professionals and buyers. For agents, it's a reminder that success isn't solely measured by the number of sales or the size of commissions, but by the quality of service and relationships built. For buyers, it emphasizes the importance of finding a home that meets their needs and fosters contentment rather than striving for more than they can comfortably afford. Ultimately, it's about finding balance and being at peace with one's choices.
I like that. Thank you. Thank you, Juniper. All right, we're going to keep our friend Juniper here, and we're going to go into other news, and we're going to talk about three things today, Juniper. We're going to talk about rents. Rents are falling in 45 of major metros, with Austin down 16% and Tampa down 8%. Why is this happening?
Well, Mac, falling rents in many metros can be attributed to several factors: increased housing supply due to new construction, shifts in population dynamics, and affordability concerns are all playing a role. As more rental units become available, competition among landlords increases, leading to lower rents. Additionally, some renters may be transitioning to home ownership, further easing demand in the rental market.
Like that idea. So basically, what you're saying is supply and demand issue. After 2 years of skyrocketing rent prices, more apartments are hitting the market, giving renters more choices and lower prices. So, in other news, also, we're going to talk about Jerome Powell and what he had to say to congressional leaders in a recent interview. Juniper, can you maybe put this into context and share with us some of the quotes? I have one here. He said, and Jerome told Congress he is in no hurry to cut rates. Any surprises there, Sol? I mean, Juniper?
Not really surprising, Mac. Jerome Powell's stance reflects the current economic conditions where inflation remains a concern. His cautious approach suggests that the Federal Reserve wants to see more consistent signs of inflation easing before considering rate cuts. This measured approach is aimed at maintaining economic stability and avoiding premature moves that could destabilize markets.
I appreciate that. And so, I believe that based upon what we're seeing in the marketplace today, that we are eventually going to be heading towards, more employment. Clearly, what's going on in Washington as it relates to federal employees, and I believe that potentially could have an impact on interest rates. But I have lived and worked in an environment where we had um, a declining GDP and rising rates at the same time. And traditionally, what we've been accustomed to is lowering rates. Hey, declining GDP, yes, the economy is contracting, but hey, if you're in a stable job and you have stable employment and you have liquidity and you have, just stability in the income generation inside of your own, household, that's great, especially if rates are going down. But can you maybe pinpoint, Juniper, some times in our recent history where we had high inflation, high rates, and a contracting economy?
Certainly, Mac. A notable period was during 2022 when inflation peaked at 9.1%, the highest since 1981. The Federal Reserve raised interest rates to combat inflation, which slowed economic growth and raised fears of a potential recession. It's a reminder of how intertwined these economic factors are.
Would you say that that would be the worst case scenario for us, though, is be in a situation where we have a contracting GDP and rising rates all at the same time?
It would indeed be challenging, Mac. A contracting GDP with rising rates can create a tough environment for both buyers and businesses, often leading to economic strain.
I recall
Balancing
I
these factors.
recall a time period in the late 90s, mid to late 90s, post Tax Reform Act of 1987, rates declined over 10 years and then started to rise again, and we had a period where we had just a long period of rising rates and people weren't buying houses. Was there any specific time frame in the 90s where that was really prevalent? I recall that it was in or around 96 and 97. We had high rates, and people weren't buying homes because we had high rates. And there was, and maybe this was just before quantitative easing, and maybe that's the reason, because quantitative easing was never an action taken by the Federal Reserve up until the Great Recession. Wouldn't you agree with that statement, Juniper? And then maybe put that into context as it relates to my original question for the 96, 97 economic time frame?
That's correct, Mac. In the mid 90s, particularly around 96, 97, interest rates were relatively high, averaging around 7.6% to 7.8%. Despite this, home ownership rates were quite high, reaching about 66%. This period was indeed before the Federal Reserve implemented quantitative easing, which came later as a response to the Great Recession. This context shows how the housing market can still thrive despite higher rates, depending on other economic factors.
But not without the control and quantitative easing on the part of the Federal Reserve. Wouldn't you agree?
Absolutely, Mac. Quantitative easing has been a significant tool for the Federal Reserve to manage economic downturns and support the housing market. Without it, navigating high rates and economic challenges can be much harder. It's a reminder of how vital these monetary policies are in stabilizing markets.
Thank you, Juniper. So let's have some, well, you know what? Before we dive into funds and puns, we're going to have a little commercial break from List Reports. And I can tell you, if you don't have a List Reports account, contact me. And it's free of charge. And all the content that you see today that ChatGPT and I are discussing, most of it was as a result of my relationship with List Reports. So thank you, List Reports. And we're going to have a little commercial here from List Reports. It's about 2 minutes. So hang in there with us, and we'll be right back. And we're going to have fun with puns. Be right back.
List Reports is a free, personalized marketing solution for agents designed specifically to save you time and streamline your workload. Looking to promote listings? List Reports is a free, personalized marketing solution for agents designed specifically to save you time and streamline your workload. Looking to promote listings? When each of your listings hit the MLS, a personalized marketing kit is automatically created for you in under an hour. It contains more than 25 ready-to-use digital marketing materials. These beautifully branded items include open house flyers, single property websites, postcards, and more. Looking to build your social media brand but not sure what to post? Check out our free shareable social images delivered daily along with relevant news articles condensed into easily digestible notables. Each shareable and notable includes a pre-written caption and is ready to post directly to social media in seconds. Looking to share listings but hate the stale feel of your MLS? List packs are perfect for sharing collections of listings on social media or directly with buyers, including homes with pools, open houses, upgraded kitchens, and more. You can also create customized collections that highlight specific market areas and home features for current clients or to share with potential buyers on social media. You can unlock even more features by co-branding with a loan officer on List Reports. By pairing with a loan officer, you'll unlock immediate access to even more features, including a library of over 500 customizable shareable images, additional marketing materials, and a custom text-to-lead code that helps you accurately capture more prospective buyers with less work. All of our marketing solutions are easy to use, mobile-friendly, and designed to engage your clients. Best of all of this is free for you to use and conveniently accessible via your daily agent email sent to your inbox every morning. Start each day off right with List Reports.
Hey, thank you, List Reports. And hey, if you don't have a List Reports account, trust me, it's free. I have many agents on this application, and if you have one and you don't know how to use it and how to take that content out of List Reports and convert it to usable brand building, then hey, please contact me and I'll be delighted to help you. I helped a real estate agent this past week Utilize her list report shareables on a daily basis to stay in touch with her community on her social media platforms. And so, with that said, we're going to hop into fun with puns with my favorite co-host. Well, actually, Juniper, I got to admit, Sol is my favorite. So, but what we'll do is we're going to have you around for a couple of weeks, and now we're going to jump into fun puns and jokes. And hey, do you want to start off today?
Of course, Mac. Here's one for you.
Okay.
Why did the Scarecrow win an award? Because he was outstanding in his field.
Well, you didn't give me a chance to answer it. I might have known that one because he was outstanding in his field. That's funny. Okay, my turn. All right. So, why did the mortgage broker break up with his calculator? Her calculator?
Why?
Because they
Because she
couldn't.
felt he was jing.
Go ahead. What did you say?
Because she felt he was just too calculating.
Nice try, but that's not the right answer because they couldn't count on it.
That's a
Ah,
good one. Her turn?
ah. Okay, your turn. You go
Got
next.
it.
You go next.
All right. How about this? Why don't secrets work in a garden? Because the potatoes have eyes and the corn has ears.
That's hilarious. So, why do real estate agents make great friends, Jennifer?
Why? Because they're good at finding the perfect match?
That's a good. I like that one. How about they always know how to close the deal?
That's a great one. Always closing the deal. Your
Yes.
turn.
Yes. Okay. Why did the home buyer go to therapy?
Why? Because he had too many issues with his foundation?
No, too many closing issues, and they didn't call Mortgage Mac. Your turn.
Haha.
Uh-huh. Okay, your turn. Your turn.
All right. How about this? Why did the tomato turn red? Because it saw the salad dressing.
That's hilarious. Okay, let's poke fun at builders right now. Why did the builder bring a ladder to the bar?
Why? To
Because
reach the high shelves?
no, because he heard they were raising the roof. Come on. Thank you. Thank you. Can you give me a drum roll, please?
Sure.
What's my favorite pun? Everyone's favorite pun.
Why don't skeletons fight each other? They don't have the guts.
That's not my favorite pun. My favorite pun, and remember this, Juniper, for the next show, because we highlight this on every show, everyone's favorite pun is bad puns. That's how I roll. Oh, that was a fun segment. So, hey, you know what? That's a wrap for this week's episode of What's Up with Real Estate. Remember, knowledge is the key to making the best decision for you and your clients. And we're going to bring Juniper on here and let Juniper, you are going to get to close us out for Saturday, February the 15th, 2025.
Thanks, Mac. It's been a pleasure co-hosting with you. Remember, staying informed helps you make the best decisions in real estate. Tune in next week for more insights and updates. Until then, have a wonderful weekend.
Hey, that's right. That's right. And Juniper, we need to work on this because Sol is really good at this. So right here, so join us every Saturday, 10 a.m. right here on LinkedIn, YouTube, and Facebook. And until next time, stay informed, stay engaged, and I'll see you at close.